Hey, this is Hutch with BankingTruths.com, and today we're going to go over the key stages of a whole life policy that's designed optimally for infinite banking. And you'll learn how to interpret all of these life insurance illustrations, because when people go out and they want to do infinite banking, the insurance agent shows them all these columns of numbers, and it doesn't really make a lot of sense in a vacuum. Hopefully it comes with a good story, but we really like to educate our clients so that they understand what they're getting into. And this video and this document, which can be found at bankingtruths.com/stages, will help you better understand what you're looking at and what questions to ask. And if at any time you're ready for personalized help in custom designing your own policy with the top 2 whole life companies for infinite banking, you'll find that we are the chefs that are eating what we sell, and you can find us at bankingtruths.com/schedule. So with that, let's get into the key questions you need to ask yourself when looking at any whole life policy. So there's 7 key questions, and I'm going to run through them real quick before we actually jump into a policy example that's found in this document, and we'll actually answer all these questions. So how much in early equity are you losing to those fees and costs? You pay a premium, not all of it's there. How much am I losing? And will the next question is, will the long-term benefits that I'm getting be worth this loss of this early access? Question number 3, at what point am I cash flow positive with new premiums? Almost like when you buy a rental property, when is the rent and the income you're getting more than the expenses you're paying? And at what point will you break even on the total invested capital? Because when you buy rental real estate, a lot of times you have origination costs, you're paying a realtor, there's all these extra costs. So at what point in the life of the policy are you just totally cash on cash break even? Number 5 is, when can you stop paying premiums? When is your policy actually self-sustaining, where you don't need to pump in any new fuel? It is just generating its own thing. And number 6 is, how strong is the cash value growth once your policy is self-sustaining? We see a lot of these policies that once you pull back from those premiums, they're kind of dying on the vine. They're petering out, versus some of them are very, very robust and quite self-sufficient on their own. And last, number 7, how much paid up death benefit do I get when I'm ready to stop paying? So all of these whole life policies, just like the name says, you're supposed to pay for your whole life. Now, there are contractual 10 pays, and we are using a term rider and a PUA rider to where you can stop earlier if you want. But when you do that, and it's not like a contractual 10 pay, you do have to reduce the death benefit, or the death benefit will just naturally kind of erode itself if you do stop paying. So with a properly funded policy, how strong is that death benefit going to be? How much of the original death benefit that you're getting will still be there? Now, to answer this question, we have to use an example. It may not be your exact numbers, but it's going to be a lot closer than you think. And that's because if you're younger, healthier than the 48-year-old male at the second best rating that we're going to be showing, if you're younger and healthier, the IRS actually makes you include more death benefit to fit the same amount of premiums. But if you're older and or less healthy, you actually get to shrink wrap less death benefit around the same premiums. So it is going to be very, very comparable. Regardless, this is the example we're using. Male age 48, second best rating, 30K max annual premium. If you can't do 30K and you can only do 10K, you can just divide everything by 3. If you can do 90K, multiply everything by 3. And with this policy, 3926 of the 30K is the base. So not quite a 1090, but not too far off, like about a 1387, if you will. 26,000 of the 30,000 is going towards PUAs and the term rider that allows you to fit those PUAs in there. We're going to use the current dividend scale for 2025, which with this particular company is 6%. Now, if we look at the actual policy, and this is what you're going to get in your document, where we have these different boxes and color codes and explanations. Again, you can download it at bankingtruths.com/stages. But the first one, yellow, just shows, okay, look, you're putting in 30,000. Again, going back to those early fees, only 24,000 showing up. Nobody likes that. I understand. But now we have to determine, are you getting a good long-term benefit for sacrificing that access early on, because what you're going to see by year 3, and that's what the blue box is, well, in that year you're putting in $30,000 a premium, but your cash value is growing by more than $30,000. So at that point, you really are like my pants video. You're moving money from one pocket to another. You're cash flow positive, as it were, on the rents. You've paid $90,000, and there's still only $82,000 in there from the missing money or the fees from those first 2 years, which, by the way, we have a whole video that explains how to quantify the cost benefit analysis, and it's at bankingtruths.com/expensive. You can check it out there. But you can see by year 5, you've put in 150, now you're over 150. Now, it used to be that this was concurrent with banking rates when they were hardly paying anything. Nowadays, you can get 3-4% savings yields. It's all taxable. So I realize you may be ahead at this point if you were just using a savings account, but most people have some sort of term insurance anyway. And what they don't account for is how much having that $500,000 death benefit, you can see over there on the right, that black box, having this $500,000 death benefit, you would have to come out of pocket for the savings account to do that. And here you don't. So you're probably pretty close to the same place by year 5. And after that, that's where things get really good. You can see we paid $30,000 for a couple more years in 6 and 7. And at this point, the policy is more or less self-sustaining in that you can see no further premiums are due after the 8th year. But in that 8th year, the dividend was $7,500. And the minimum premium, so $30,000 is the maximum you can pay, but the minimum that you have to pay for just the base policy and the term rider, with a little bit of PUAs to sustain the term rider, is $7,000. So that's less than the dividend. So at this point, the policy is really self-sustaining. Now, we can do something else too. If you look over on the right with that red box, that's what's called a reduced paid up. And so at that point, even though it's not a contractual 7-pay, like we didn't lock ourselves into that, we have a lot of flexibility. You can pay this for 20 years, for 30 years, till your whole life. But if you wanted to be done paying, you could reduce the death benefit. And nobody likes to reduce anything. Like, wait a second. It's funny because people even say, like, I don't really care about the death benefit. And we're like, well, you can reduce the death benefit if you want to stop paying. Like, I don't want to reduce the death benefit. Well, wait, I thought you didn't care. It's actually better than you think. Because if you remember, we started with just over $500,000. And even though that death benefit grew because of our paid up additions and overfunding the policy, even though it grew to $643, and it could stay there if you continue to pay even just $7,000, that minimum premium, by reducing the death benefit, 0 premiums are due, as you can see in year 9 and 10. And you actually have more death benefit than you started with, and it's all fully paid up. So again, this is something else you have to look at. Some of these policies, when you do a reduced paid up this early, like in year 7, you end up with a lot less death benefit than what you started with. You might have started with 5, but you're going to end up with like 2 or 3. And that's because of the watered down, they're second-rate policies, oftentimes from second-rate companies. So there's lots of things you can do to design. This design is so robust, as is our second favorite company. And I'm not going to mention any company names here because I don't want anybody to get their feelings hurt. But we're happy to model this for you on an individual basis at bankingtruths.com. By overfunding fully for the first 7 years, you actually end up with more than what you started with. And that pink arrow, notice that the year before you stopped paying, you had about $250K of cash value, 248, a little less. 5% of 250K is $1,250. Well, you're earning more than $1,250 off less than 250K, and you paid 0 premiums. So this thing's really kicking butt. Like, how good is the performance when you turn it off? And we found with a lot of the watered down designs that are out there, that if you do that, and we're seeing this with clients who have had these policies for 10 years, 12 years, 8 years, they're coming to us, they're ready to kind of slow down or be done. And we're showing them that as soon as they stop paying premiums, their policy falls off a cliff. And if they do a reduced paid up, well, it just shrinks wrapped to like almost nothing. Right? And so they're kind of caught in this trap, in this cycle. And we prefer to design policies that are self-sustaining. All right, so the rest of our stages document, what we do is we basically You take the same policy, the same design, it's the exact same everything, but we fund it differently because going back to with a policy can have a minimum premium and a maximum premium, and you can pay anywhere in between as long as it has that flexible PUA rider and as long as it has a big term rider. You're not locked into that funding scenario you just saw on the last screen. And so we go over some different funding scenarios like this. Sometimes people, they know they're coming into money and they want to open up the bucket and get it started and lock in their age, lock in their health, get those first years or the worst years out of the way, but basically open up the bucket to be able to maximum fund. This shows an example of doing just that. And what you'll see is you don't get to the same level of cash value because you put in less. You hear me say it all the time, put in more, put in less, get less. But because we're able to shrink wrap a policy, you can see that you get to the same level of performance, like that over 5%. Here at the end of the payment year, you had 150. 5% of 150 is 7,500. Here you're earning more than 7,500. So even though you put in less, you still get comparable growth, which is important. So flexibility is very important to a lot of our clients, and that's why the remainder of the doc, the free report, goes into the exact same policy, but funded different ways. And so a lot of times people will have money coming in, they want to start the bucket, they want to get past those first years, the worst years, by starting with a small minimum premium, but opening up the bucket with the flexible PUA rider so you can overfund as soon as money comes in. Well, that's what this example is right here. And if I just put it right on top of the original example, instead of paying $30,000 for 7 years and then just the minimum $7,031, we're going to pay $7,031, max funded for 4 years, and then for whatever reason you can't, right? You put in less, you get less. I say that all the time, put in more, get more, put in less, get less. And it's the same policy. And even though you didn't max fund it for as long, because we can shrink wrap the policy, you can actually get comparable performance. So you're obviously not going to end up with as much money. Like the one you end up with 177,000 and the other you end up with 275, but that's because you're missing actually, there were three $30,000 payments that were missing here. So obviously you're going to have less money. But the relative performance, if we look at those pink arrows again, if you remember, you put in less than 250, you got more than 1250, that 5%. With the smaller version, or it's not even smaller, you just paid less, so you have less PUAs. You have 150, 5% of 150 is 7,500. Here you have more than 7,500. So you're getting comparable performance. It's just a little bit of a scale model, and you don't need to decide today which of these funding levels you're going to do. In fact, a lot of my clients worry about what happens, like, oh my gosh, if the whole world comes to an end, what do I do? So this is the exact same policy. If you did 30,000 up front and then things got bad and you're like, I can only do 18, and then things got worse, it's like, I can only do 12. And then after that, it's like, gosh, I don't even want to pay the minimum because things are just going so horribly and I can't get another job and all my investments went to crap or whatever. Well, notice, even if you just pay the minimum from years 4 through 7, which you are required to pay at least 7 pay, you could borrow from the previous years, but even if you didn't, you put in 7,000, how much is the policy growing by? It's growing by 88, right? The next year it's growing by 99. The next year it's growing by 10,000. And then you end up with 91,000, put in less, get less, times that by 5%, that's 4,500. Well, guess what? You have more than 4,500. So it's actually going pretty well for you. So it's normal for people to want to spend a lot of time worrying about what happens in the worst case scenario. It's our primal brains are wired that way. Totally get it. But what they don't spend a lot of time doing is what happens if things go right. And we're going to look at that in just a moment. I remember this meme. I thought it was really, really funny. It says, worrying works because 95% of what I worry about never comes true. So we like to also spend time not only just educating people on, hey, if things go horrible, that's what you just saw, and that's part of our process, but also what happens when things go right. So the same policy, you can max fund that 30,000 and then just kind of min fund to keep the bucket alive. You can actually do a catch-up premium where you can go over and above those IRS MEC limits which was 30,000, and you can put in 32 or 52 because you're making up for an extra 22,000 of overfunding. That's 30 minus the 8 that you can see from the year before that you didn't get in. Well, guess what? You can go ahead and do this with this policy, and you can hopscotch it. And there's a value to overfunding a policy, or at least paying the minimum to keep the bucket open so you can keep overfunding later. And it has to do with like the typical retirement conversation. So I'm sure a lot of you have 401ks and you have those stupid target date funds where it's like, okay, I'm retiring in 2040 or whatever. And what they do, the fund does what you're kind of seeing in this picture, where you start with more stocks because the idea is you're younger, you can take more risk, and you can take less risk later on. There's actually studies contrary to that. I digress. We're going to be coming out with a lot of retirement content in the future, in the near future. But for now, I just want to say that you don't need as many, call it bonds, in your retirement accounts if you're using whole life as your bond proxy, because it really is like a supercharged bond, a bond with superpowers. Because if you look at 2022, this data from CNBC, bonds lost almost as much as stocks or more, depending on what kind of bonds they were. And most people don't even know what they have in those accounts, those target date funds. They just kind of have like a basket of everything, because when the Fed, when the Treasury, when companies are selling these bonds, they have to have buyers. And a lot of you are the buyers and you don't even know what you're buying. And versus when you use whole life as more or less the bond proxy of your portfolio, what's great is the insurance company gives you that principal protection to where even though if the bonds lose money on paper, they're giving you that contractual guarantee because they have the cash flow where they can hold those bonds forever. And it doesn't matter if they lost money in any given year versus it does for you in your retirement. I digress, but we talk a little bit about retirement scenarios, how to fund a policy and kind of keep it open for all those years, but also my red light, green light, like using whole life as part of a retirement model. We go into how the same policy can be used for that. And lastly, just touching on those fees, again, you can go to bankingtruths.com/expensive, and that goes into a video which really details this. Like we saw in the first couple of years, you paid $60,000 of premium, 30, and then 30. But in the first couple of years, you only ended up with $51,000 of cash value. From that third year on, you remember you were cash flow positive, but you're like, oh gosh, 9,000, almost 9,000 is gone. What did I get for my 9K? It's actually $89.25. Well, we actually go into showing you it with this particular policy, like what you actually get for that money. And you get a couple of things, and it's pretty big. You get death benefit over and above your cash value, which even if you don't care about it, like somebody in your family still gets it. And like that unto itself, this is something we measure for our clients. And we also do on that video, the bankingtruths.com/expensive. We measure that that's a pretty good rate of return, 9,000 equaling over $250,000 of death benefit, but it's also the tax savings. So you put in $366,000 into this policy. By the time you're aging 89, there's $2 million of cash value. That's like over 1.6 million of what would be taxable income in a savings account that you paid zero tax on. Well, what would your tax bill be on 1.6 million? Like $500,000, something like that? Would you pay $8,900 for the next 2 years to save over $500,000 in taxes for the rest of your life? Most of my clients say yes. And it doesn't matter whether you like the death benefit or not, you still kind of get that as a bonus. So is it a good deal? Well, that's something we help you measure. At any rate, hopefully you enjoyed this walkthrough of our key stages report. If you have questions, again, look us up at bankingtruths.com/schedule. Happy to do this on a customized basis for you. Also, you can download the report if you want to go in detail with the PDF itself at bankingtruths.com/stages. Hope you enjoyed this. We'll talk to you next time.